as we've decided, now it's time to start thinking about 2025. And a lot of what I'll be discussing will be from that perspective. So before we get started, this is not financial advice. This is purely for educational basis. To read the disclaimer. Today, we'll look at the recent price action and form our views on what capital has been doing. We'll also take a look at the macro backdrop, especially going into 2025. And then we'll take a look at what are the constituents of a good long trade idea. We'll do something that I call dumpster diving. This is particularly useful as we come into the year end and we try to find good ideas for the next year. And then I'm just going to lay out what the roadmap should be looking like for you going into 2025. Let's start off with some notable charts. So we've got the S&P at an almost all-time high. So last week it broke to a new high. And then this week, I think it was a bit of profit taking and, still in a very strong bull market. Let's not forget about that. Take that into perspective whenever you're generating ideas and also whenever you're looking at financial media that's telling you that the market is just weak and is going to come to a crashing halt. Look at this chart. Every single day we've had negative news about why the US stock market should be going much lower, and it's just been doing the opposite. So that's a big clue for you not to read stuff that don't make any sense. When we look at the QQQ, it's not been able to break out conclusively yet, and I think with the long-term rates being elevated, it might find it a bit more difficult to make new highs here. So there is a real risk of a pullback in the Nasdaq. And if you're looking at long tech or long high PE names, you have to be aware of that. It's going to be a bit of a headwind. So just make sure that if you have any long software tech ideas, that they are extremely fundamentally strong, and probably also have a short tech, just to make sure that if you have a significant pullback in the Nasdaq, that you're not caught out significantly. So that's how you need to be interpreting this. So in terms of tech, high PE, we're not seeing a lot of strength. So if you still want to be long that space, find situations that will put the odds in your favor. Moving on, the IWM, the Russell 2000, we've been looking at this quite closely over the year. So we've had breakouts from past levels, and now it seems that we've made a new high and then we stalled. So again, it's looking like a breakout or a bull rally that's gonna be probably grinding higher. So we'll get a bit of a pullback, move sideways, and then eventually it will go back higher. And again here, because small caps rely on looser financing conditions, with the long-term rates being elevated, it's going to be a big headwind. So I think irrespective, as the Fed cuts rate, we will see this space get back in focus. But if you're positioning your portfolio for massive longs in the small cap space, you just need to be aware that, at the index level, you're not yet seeing like a conclusive breakout. It doesn't mean it cannot happen next week, but just make sure that every situation that you're playing in your book is kind of taking these market conditions into account. So as an example, let's say if you are playing a long small cap idea through options, just make sure that you're not positioned too far out of the money, that maybe the duration of the trade is slightly longer than just a couple of weeks. That's basically how you stack the odds in your favor. And then finally, something we haven't really touched on previously. So the USD, from the end of September, the USD has been showing incredible strength. And if you can see it's been ranging for a number of years within this particular pattern, and it's been predominantly between 107, 100 and 107. It's been trading within this range. Um, where does it go next? I have no idea. Could it go? Could it go much higher? Yes. Could it go much lower? Probably. Could it keep ranging? That's highly likely. So we're just taking note of what these key macro forces are doing, and then as we get conclusion of the direction one way or the other, we know exactly what the impacts will be on the equity markets as well. I'll talk a little bit about the USD in the next few slides, because that's going to be a driving theme for 2025, and it's important for you to understand how everything works, under the surface. And then finally, I've been speaking a lot about this, the US 10-year yield. So um, given that the Fed has been cutting rates, you would expect the long-term rates to also be falling in line, but it's been doing the opposite. So many theories out there. I think the market is basically saying we don't trust the Fed. Whatever the Fed is doing is probably too dovish, and they are likely to cause a reacceleration of inflation. And keep in mind that the 10-year yield is looking at the 10-year horizon. So it's not saying that CPI will be higher next month. It's basically saying that our estimation of CPI over the next 10 years is probably going to be higher than what was previously anticipated. And when you look at the setup, it makes a lot of sense. So you have, Trump as the new president, and he might be doing a lot of things that worsen the deficit of the US. He might also be doing a lot of things that are highly inflationary. So if he wants to stimulate the economy, whether that's by bringing back manufacturing, whether that's by virtue of having the crude oil prices much lower, a lot of these policies are highly inflationary in nature. And these policies would also not just play out in a couple of months. These are multi-year themes. This whole manufacturing reshoring. He's been talking about it from his previous term, and it's not something that's early. It's been happening under the surface. And as you set up more industries in the US, so you basically need a lot of the building blocks. And, we've seen that with China. When China was kind of building out the infrastructure, the economy, it was highly inflationary. So commodities had a massive boom. And now we have the US doing it. So the US is probably going to be on a different scale. And you can only imagine why the US 10-year yields are behaving in the way they are. So how does that matter to us? You can think of the long-term rates as gravity for the equity markets. All the valuations, everything is tied to the long-term rates. If these go up, by definition, the reaction function is that equity prices would tend to go lower. Of course, there's not just one factor that controls equity prices. You've got a multitude of factors, but one of the core ones that control valuations of stock is the long-term rates. So that's a big headwind for many stocks, especially the ones which are highly valued or high PE tech stocks and so on. And that's the reason why you'll see a lot of tech stocks, even if the results look good, they have been selling off 20-30%, because the investors are saying we probably need 10-20% higher growth levels to justify the current valuations. So that's kind of been the setup, not very intuitive to many, but that's actually what's unfolding out there in the market. So you have to pay attention and make sure that you're aligned with everything that's going on. You're paying attention, you know what's driving the equity markets, and the way your book is positioned also takes that into account. And finally, I've got the US, so the WTI crude oil prices here. We've been discussing this quite a bit. It's been on the decline for almost the entire of 2024, if I'm not mistaken, or maybe from early 2024. Um, this is quite interesting, right? Because crude oil is a bit of a, it gives you an indication of how tight the physical oil demand versus physical supply are. So for many years, we've had, especially coming out of COVID, we've had issues around the supply chain or the supply end of crude oil because there's not a lot of investment in drilling, fracking, and all of that. Because when COVID happened, economic activity reduced significantly. So demand for crude oil decreased accordingly. And therefore, a lot of investment into oil and gas exploration and drilling just stopped. So that created a bit of a supply reduction and quite frankly a gap between supply and demand when economies restarted and we had the end of the lockdowns and so on. And now we've probably normalized, and what's being priced by crude oil here is basically China not growing or having significant issues with its economic engine, but also many places in the world, Europe, UK, not necessarily booming as much. So a lot of the oil demand, if you go through the OPEC monthly report, you'll see a lot of the oil demand is coming from India. Uh, and that's literally been, the kind of the beacon that's been, flying higher. And there's a lot of political things around that, mainly in terms of they're importing Russian crude oil and then selling it off to other parts of the world, and all of that goes into the oil demand from India. But let's not stray or get into these arguments. What's important to understand here is the backdrop for oil demand is no longer as strong as it used to be in the past, and the question really for us is this going to change? Are we going to see more supply? Let's say Trump comes in and he says, okay, we need to be number one oil producer in the world, and I want the margin to be massive versus OPEC because that gives me negotiation power. So of course, the world economy is not set up to be able to take in much higher levels of supply, and that's going to drive prices much lower, which would work for Trump because he'd be able to say, look, I got your gasoline prices lower, jet fuel prices lower, inflation is well under control, and so on. But we also have the opposite of the coin where, let's say you have reacceleration of global economy because China is stimulating and other countries are able to, kind of get their way out of this whole growth, let's say growth slowdown, then you might have an uptick here. Oil is also a measure of geopolitical tensions. So these geopolitical tensions have probably been at its highest. And with Trump coming in, I don't know if that increases or decreases. We'll get to see from his actions. But we've certainly seen an escalation in the Middle East, with Israel, with, Lebanon and all these countries. So at the moment, none of these countries are significant oil and gas producers. So we haven't really seen an uptick in oil prices based on the geopolitical tensions, even if there's a lot of oil that transits through that region. However, I think the stage is set for a lot of unknowns, and with Trump coming in, he's obviously promised that he will put an end to the war in Ukraine, to the war in the Middle East, and we'll have a much more peaceful world. But he also says things like he's going to bomb Iran and, he's going to do terrible things to control them. And I don't know if this quells geopolitical tensions or just increases it. I think these are all things we have to keep in mind and stay flexible with our mental process. and just don't have a portfolio that's either gonna benefit if oil goes up or down. Just keep that in mind when it comes to diversification. Um, Moving on, so let's quickly look at what capital has been doing on the week in terms of US equities from a sectorial perspective. So as we've seen, the market has been down despite material inflows of capital after the election. Um, Tech and real estate continue to face big headwinds. We've spoken about the US 10-year rally. And even before the elections, we could see that tech and real estate were having massive issues, particularly real estate, right? From the first rate cut of the Fed, real estate has really been underperforming, and we haven't really seen any signs of strength there. We also saw that consumer discretionary has been a big outperformer for weeks. So I think last week we got the consumer sentiment report, which was a little bit higher than the previous month. So that really paves the way for, let's say, a healthier consumer spending environment going into the year end. And I think that's quite positive for the US economy. A large part of the US GDP ties back to US spending, US consumer spending. So, that's overall a positive for the economy. And if we are looking at even the ISM, we're seeing upticks in the retail trade section and a few other sectors that are highly consumer discretionary. So if you want to look at long ideas, I think that's probably an area to start looking at. Although you're not early here, so just be very well aware of that. Consumer discretionary has been up 7.87% on the month. So you're definitely not early here. And the rally started many weeks before last month. In terms of materials, it's been a significant underperformer. So I think that ties back with the ISM industrial activity, slowing down alongside GDP as well. So that's probably a sector to keep watching out for, especially if you're looking for good shorts. I think you might be able to find a few good ideas there. But also, that's a sector that could undergo revival if you suddenly have all these capital expenditures that come back into 2025 and people are starting to build out new industrial facilities, warehouses, etc. We've also seen quite strong activity in commercial construction. Anything led to US infrastructure has been very strong on the year. So keep that in mind. It's a big, it drives material sector quite significantly. And of course, within the materials sector, you've got pockets that are doing really well and pockets that are probably not performing that well. The biggest one, so what's happening with healthcare? It's down 5.55% on the week and 7.2% on the month. So, that's a serious underperformer. What's happening there? It's literally just the Trump. It's been the Trump trade, going into the elections. So I don't know if you know much about Trump's previous term, but he's been trying to get rid of Obamacare for a long time now. So he did not manage to get his version of healthcare policies approved in his last term. That was blocked by the Senate. And there's a lot of talk now that he's going to try and do that during this mandate. And it's an area that you have to read a lot more about because US healthcare is very complicated, and you also need to understand the intricacies before you find long and short ideas within this space. So just to maybe wrap it up quickly for you, basically areas that benefit from government subsidies in terms of healthcare plans are coming under pressure. So you would probably see a lot of managed healthcare, um, a lot of companies involved in this space that have been selling off quite drastically. So one of the companies that I've been looking at is, I think the ticker symbol is CNC. Uh, of course, that's not just one idea out there. You have to read and understand the whole environment around, all these policies, and then pick your winners and losers accordingly. So even if healthcare is coming down, I'm pretty sure we could have quite a few good long ideas within there as well. And that could work if we get a defensive move within the market. So keep that in mind. Even if it's been the biggest underperformer for weeks, it doesn't mean that you should just chase the move and be short everything in healthcare. Um, Moving on to industries, again in the US equity segment. So we've seen this for weeks now. Airlines have been a big outperformer, and that's thanks to lower crude oil, which essentially translates into lower jet fuel prices. Software internet stocks, their outperformance have come to an end. Again, the long-term rates have been a big headwind. We've also seen a big sell-off in biotech alongside healthcare, right? So I'm not exactly sure what it comes down to, whether that's just a risk-off move, whether there are regulatory risks now with Trump coming in, which could well be the case. So Trump has kind of hinted that he wants a healthier America. And we know that the biotech or even the pharma space has literally been thriving off, the US not necessarily being the healthiest nation on earth. So I'm not exactly sure what's going on within this space. It's not a space that I trade actively, but it's important to understand, if there's something important happening. We've also seen home builders struggling. So remember when the Fed cut rates in September, everyone was excited and saying, yeah, home builders are going to have a new bull market. And I was literally saying, even before the Fed cut, that housing is a space that you should probably start looking at for shorts. So completely separate from what the financial media narrative was, or even retail trader, even professional traders, to be honest. So a lot of them were painting, like a totally new bull market for the home builder space. When I was like, no, rates are still too high, and that's not going to stimulate demand for new housing. And we're seeing it actively now. We're getting comments from people within the space which are saying we need the rates to be at least 150 basis points lower to start seeing any meaningful uptick in activity. And what we also heard from Powell on Friday was that he was not in a rush to cut. So he probably is getting cold feet about the rate cuts now because he's seeing crypto go through the roof, and equity is also flying through the roof, and he's wondering to himself whether he's doing the right thing. And at the same time, he knows that even if inflation has been coming down, it's kind of been stalling at the current level. We haven't really seen, a new low in inflation. So I think Powell is starting to rethink his strategy, and he wants to buy a bit of leeway for himself, because I think more than anything, he's afraid of inflation reaccelerating, especially as the job market gets weaker, because then he has, his two supposed measure that he uses to, make sure you have a healthy US economy. Both of these metrics are going in the opposite direction, and any stimulative action that he will need to take, will literally be sacrificing one for the other. So if he wants to save inflation, he has to sacrifice the job market. If he wants to save the job market, he'll have to sacrifice his inflation ambitions. Um, so that's the difficult place for him to be. And in 2025, expect to see him, play on both sides of the field. He's been known to be like that. That's the nature of the beast. So whatever you hear him say on a Wednesday, expect him to say something a little bit different on the Friday. That's literally how he functions. Um, I've watched him for many years now, and that's been my conclusion of the takeaways from all these Fed meetings. Never come out with a clear sense that, yeah, I know exactly where the Fed is going in the next 6, 12 months, because they're exactly like us. They're looking at the same metrics, and they're more than aware about the risks of stimulating the US economy too much. Um, and of course, as a committee, they all act in unison on that basis. Moving on. So, solar and clean energy, another post-election victim. So, Trump has been quite vocal that he believes the whole clean, green energy is a sham, and it's basically been a narrative pushed for many years to, you know, it's like a new form of tax that's been put on people, whether that's the carbon tax in Canada, Europe, or policies that just are stifling for businesses, or policies that just make investment more difficult. So over the last decade, we've seen a lot of investment within the solar, wind energy, and other clean energy space. Um, I think that's positive because when capital goes into that space, you eventually find people who come up with new technology that allows you to produce the same materials with a much lower carbon footprint, but it comes at a big cost, and not all the investment that goes into this area is productive per se. Um, and also, I mean, it's not difficult to see that there are lots of people that benefit from this agenda, and that's the reason why they keep pushing it. So, what does it mean for us in terms of equities? Um, we could have further weakness within the solar and clean energy space. The solar panel space itself is rife with extremely, you know, poor situations. Many companies trapped in lawsuits, and you know, companies that have not been profitable for many years and basically just burning investor capital. Because you have to remember, for a long time they've been beneficiaries of equity inflows because a lot of funds wanted to be ESG compliant, so they would have a dedicated allocation to a lot of these companies, irrespective of their fundamentals. And that's literally been capital that's been burned. And now we're seeing a little bit of a move against this whole thing. So it's a little bit like capitalism is back in full prominence, and you have to keep that in mind if you're managing a portfolio. Whether you believe clean energy is good for humanity, the earth, or whatnot, you have to understand that capital does not normally depend on how you view the world. Capital moves according to the returns that it can generate, and that's always going to be the first and foremost rule. So, final slide on price action analysis. This week we've been seeing capital moving to the large cap value space. So, quite a defensive move, if you ask me. We've been saying for weeks that the value segment is probably going to see a lot of capital rotation. We've seen it for a number of weeks. Then we see capital move back to the growth space, small caps, and so on. On a monthly basis, we've seen small caps and mid caps still outperforming. So I think that's a trend that will keep happening for the next few months, and it's well worth looking for long ideas within these spaces. Um, As we've discussed, the long-term rates are a big headwind for small cap and mid cap companies. A large part of the reason there is because these companies rely on cheap debt and also availability of debt. So if long-term rates are staying elevated, then there's a big refinancing risk for many of these companies because every year or two they have to refinance, and there's a risk that they have to refinance at much higher rates if the long-term rates are not coming down. And also, long-term rates impact valuation metrics. So these companies will not be able to trade at higher PE ratios if long-term rates stay elevated. So that's it about price action analysis. I wanted to talk a little bit more on the USD strength. So we've seen from the slide before, right? Uh, it's undeniable that from the end of September, the USD has been extremely strong in terms of its performance. And we have to understand the reasons behind it. So the US is definitely attracting capital. It's got a strong economy, and capital always chases growth. We've also had the big investments in AI. So the US has been a prominent actor with AI development, whether that's in terms of software or hardware. We're also seeing the acceleration of reshoring of manufacturing to the US. So that means that you see a lot of repatriation of capital from the global corporates who are basically like closing factories in China and moving all their money from China to the US. So of course, that increases the USD's value. Uh, Although this is not something that's been happening from the end of September only. It keeps happening in the background, but it's a big factor that contributes to the USD strength. We're also seeing other economies relatively weaker with higher risks of investing in them. So the EU, UK, China, rest of Asia. Um, as an example, in EU and the UK, it's not just that the economies are performing poorly. There are also higher risks of investing in these countries because policy changes are at an all-time high. In the UK, you had elections. In EU, you continuously have policy risks. The EU is probably the most bureaucratic place on earth, so it's not capital friendly. And of course, if the economy is not doing well, uh, investors will not think twice about moving capital away from these parts of the world to where capital is welcome and treated well. Um, we also have reduced policy uncertainty now that the elections are over. So still, Trump hasn't made it clear exactly what his plan is. He's spoken about a few things, including import tariffs, but we haven't seen a clear plan and timeline in terms of implementation. But if we know anything from his past term, we know that he'll follow through on his word. So you have to be positioned from ahead. So once the elections were over, it was clear that this whole talk around import tariffs will definitely uh, will definitely be happening. So um, the question to ask ourselves is are the import tariffs fully priced in now? If not, we could be seeing more USD strength. So for those who don't know, you probably need to read up a little bit on this. If any country that is a net importer that imposes import tariffs essentially is going to cause depreciation in the foreign currencies of the countries that are exporting to it. So if, as an example, let's say Trump says everything coming from China is going to be taxed at a 20% rate, that basically means that the Chinese yuan needs to correct by 20%. So it has to depreciate by 20% to be able to keep everything, you know, to be able to keep the levels of activity the same as before. So this is a bit of theory. It doesn't always need to happen like this, in reality, especially if you have animosity between China and the US, and China itself is like, okay, I'm not going to export more to the US, I'll find other markets. So that might not necessarily translate into a one-for-one depreciation, but overall, what it means is that we're going to see foreign currencies depreciate versus the USD. And I think a large part of the move from September is trying to price in this whole import tariff, at least partially. So um, with the Fed cuts, we're expecting to see that the rest of the world will also follow in a similar manner when it comes to monetary policy. So they will also be cutting rates. And as a result, what I believe might happen is the interest rate differentials. So basically, the interest rates that you get in, let's say, South Africa versus the US, that would probably be expected to stay the same. So if the US cuts by 25 basis points, South Africa will cut by 25 basis points. So that differential stays the same. And it's not necessarily going to change the strength of the USD or decrease it or anything like that. However, what we could also see, and I think that's the more likely scenario, is as GDP slows down in other parts of the world, many of these other countries might start cutting faster than the US to stimulate growth, and that would increase the interest rate differentials, causing capital to move further to the US, which in other words means USD is going to get stronger. So I'm not sure exactly in which direction this will go. I'm just painting a few scenarios here. Just keep your eyes open to see which ones of these are playing out, and understand that the USD is going to move on these factors. Uh, while all of this is happening, you also have a big issue in the US with the ballooning deficit. So that's becoming increasingly worrying. And the big question is, will Trump be able to control this? So Trump has been putting forward a few policies that, from my perspective, are untested, untried, and that increases the prospect for negative surprises, right? Because uh, there hasn't been a country that has implemented these measures on such a large scale. So we don't necessarily know what the end results would be of implementing these policies. So it might be positive for the deficit, might be highly negative, who knows? So keep that in mind. The USD strength will be impacted by whatever happens to the deficit numbers. So why do we care about the USD, whether it gets stronger or weaker? These are a few scenarios here. If you have a stronger USD, you can expect emerging markets to be in crisis mode. So we'll have sell-off in emerging market bonds, emerging market equities. Um, you can also expect that to be a headwind for US exporters, because that basically translates into lower US revenue. So from our analysis, we've seen many companies that have, let's say, 30–40% of their revenue uh, exposed to other parts of the world. Percent of your revenue is now being valued at 10% lower in terms of USD. So that's a big headwind for these companies, because their cost might still be in USD and their revenue is in foreign currency, which translates into lower USD revenue when you convert it with a stronger USD. It would be a tailwind for US importers. So if you have a stronger USD, raw material costs are lower in USD terms, which allows them to increase their margin. So imagine you're importing from Mexico uh, and then selling into the US. So you have revenue in USD. Your costs are largely in the Mexican currency. And if that's going lower versus the USD, you don't necessarily need to pass on these savings to your customers. So you could retain a higher margin for yourself. So that would be a big tailwind for companies that operate this business model. A stronger USD will also mean commodity weakness. So this would be bad for mining companies, bad for commodity-driven currencies like the Aussie dollar, South African rand, a few others as well. We don't discuss currencies that much, so I'm not going to go too much into detail here. A stronger USD could also be deflationary. So does it mean that if we're getting inflation slowing down massively, that the Fed starts to intervene faster? What does that mean then? If the Fed starts getting nervous about a stronger USD, they could start intervening and cut rates much quicker. So what would that mean for equities? That's for us to start thinking about, right? On the converse, if we have a weaker USD, that could translate into an emerging market boom. So you could look at indices like EEM, individual stocks in emerging markets. I think Latin America is a good space to start looking at, particularly countries like Brazil, Mexico, maybe even I'd probably stretch it to Canada as well. If you're looking for exposure outside of the US, these are probably places to start looking at if the USD weakens. It would be a tailwind for US exporters. No need to explain why. It's quite evident, right? It would be a headwind for US importers because raw materials cost higher in USD terms, and that would reduce their margins. It could lead to a commodity boom, which would be amazing for miners because miners have been in a bear market for many years, and the slightest increase in commodity prices could cause these companies to attract capital and re-rate much significantly higher. And then the big elephant, the carry trade unwind. So we've seen this in August of this year, where Japan started saying that they would be increasing interest rates, and that caused a big unwind in the carry trade between the USD and Japanese yen. We've spoken quite a lot about it, but now what's been happening in Japan is there are doubts that they would be able to follow through with the interest rate rises. So that's kind of put a pause onto this carry trade unwind, and people are even starting to think that Japan will not be able to increase the interest rates. A large part of it is because of post-elections. They no longer have a parliamentary majority, so it would be difficult to implement such policies. And who knows how this is going to go. The Bank of Japan is probably the only one who can tell us where things are headed. But we have to keep this in mind. If we have a carry trade unwind, like in August, that this is going to be very bad for tech stocks, and you could even position for these things. It's all a matter of knowing what's happening under the surface, and watching out for clues from the market that something is changing significantly, and then that gives you enough conviction to position for one of these scenarios. So as traders, what's our job, right? We're always searching for alpha. We're looking for ways to generate alpha. Just a little bit of theory. So beta is basically performance that's driven by the broader market. So you would hear me a few times saying, oh, the stock is just drifting higher in line with the market. As an example, let's say we have a stock that has a beta of 1.5. The market moves by 2%, and then the stock moves up by 3%. That's literally the market moving that company's share price. However, what we are in search of is alpha. This is performance that's driven by stock-specific fundamentals. So that's the reason why we spend so much time obsessing about stock specific fundamentals. We spend so much time digging into their financial reports, the SEC filings, the investor presentation, trying to understand how things would look at the next few quarters. And that's literally because we want to generate alpha. But in reality, what happens is our trade performance will always have a mix of beta and alpha, right? Let's say we decide to buy, as an example, let's say Nvidia, right? So by buying Nvidia, you're buying the company fundamentals, its prospects for the future. But you're also buying tech. You're also buying, the U.S. equity uh, within that trade. So you have to understand these are the three risks you're taking. You're taking stock-specific risk, industry risk, and then you're taking market risk. And as traders, what we always try to do is we focus on alpha generation, so stock-specific fundamental factors, and then we try to hedge out our market exposure through portfolio diversification. So people who have been within the professional trading or portfolio management space would have heard of this term. We want to maintain a beta neutral portfolio. This is basically what it means. You're trying to get the beta of your portfolio to as close as zero. And essentially you're saying, I don't know where the market is going to go. I don't want to take a bet if the market's going to go up or down. My bets are on stock specific situations. And at the end of the day, I want to build a portfolio in such a way that it's diversified, and on a portfolio basis, I don't really care if the S&P is going to go up or down. I'm going to pause here and just open the floor for any questions that we might have. Please go ahead. No questions?
I may have one question on the carry trade
Okay.
point what you made, Roshan.
Yeah.
Like you mentioned like another investment interest rate increase in Japan will unwind another carry trade, but are we starting with the same exposure though? Like how much of the exposure to Japan raising interest rate has come down because of the last
Mm-hmm.
carry trade? And do we
Uh,
have any data on that?
Look at the USD and Japanese yen chart. We won't have an idea of the exposure, but you can see, let me bring that up for you. Traders are traders at the end of the day. They have very short memory. Can you see this chart?
No,
No.
I'm still
Okay.
seeing the
Okay.
presentation.
I'm going to share my. You can see the chart now, right?
Yeah, I see it now.
So this was July, right? So for many months we've been having USD strength versus the Japanese yen, and then one day they just decided we've had enough of this and we want to save the Japanese yen. And this is basically start of July, and then we start having the turmoil around here. I think it was probably this last week in July going into August, right? So
Hmm.
you can see that there's been a bit of an unwind here, right? But if the Bank of Japan implements policies that is contrary to what the Fed is doing, so the Fed is cutting, the Bank of Japan is increasing rates. That's a big problem, right? Because it means that this whole move, right? This is like a multi-year move. This whole move is probably going to unwind. Even if it unwinds to 20%, that's a massive move from where we are. And as you can see, so we kind of bottomed in September, and then the USD just took over, right?
Yeah.
So what do you think people would be doing when they see, oh, this minor crisis we had in August was just nothing, right? They would go back to the same old playbook, right? especially if they are starting to think that it's becoming more doubtful that the Bank of Japan will be able to increase rates because the political support might not be there. So, then they double on their previous bets. They have the same playbook, right? Borrow cheaply in the US, um, sorry, borrow cheaply in Japan, invest in the US in tech, and
Yeah.
if the BOJ basically just says, okay, we don't care, we're going to hike to save the Japanese yen, then these guys are caught out and will have a much more extreme move because if they actually start implementing rate increases, let's say, within the next few weeks, we hear them rising rates by 50 basis points. Can you imagine what's going to happen,
Yeah.
right? Uh, and if in the commentary they say, okay, this is the start of many rate increases, then this is probably going to go down to 120 and eventually to 100. And as this is unwinding, this is causing a lot of pain for people who have the carry trade on. And all that money is parked into Nvidia tech stocks. So they will have to sell these stocks, get the USDs, convert that into Japanese yen, and close that whole trade, right?
Yeah.
So you can see how that's going to translate into price action within the equity space, right?
Yeah.
Does
That's
that
how I
answer your
understood.
question?
Yeah, that's how I understood how the
Mm.
what is the carry trade is. It's just I was thinking like, are we still positioned with the same
Mm.
amount of capital as before?
See, these are surprise events, right?
Yeah. Yeah.
Um, because you'll just wake up one day and read a story about the BOJ hiking rates. It's
Mm.
not something that could not have been predicted. They they have meetings like the Fed and they're talking, they're giving their views on what policy is going to be in the future. But then people are selective about what they want to hear. And we don't follow the BOJ that closely, right? Um, a lot of the documents are not as easily available as the Fed, probably not in English and so on. So we follow what the BOJ is saying from the financial media, right? And we only get to hear what the view of the reporter is or what the reporter is choosing to push as an agenda. So that might be very different from reality. I mean, we see this in the US now. Imagine when you have like a language barrier in Japan, plus a financial media that doesn't necessarily have your interest at stake, right?
Yeah.
So that's why it's always important. If you want to keep track of this, just watch this, the USD Japanese yen. If you start seeing the USD falling in strength, right? I mean, you don't even need the carry trade to unwind because BOJ is doing something. You just need the USD to start weakening because people who have the trade, especially in the last few months, they'll start undergoing a lot of pain, right?
Yeah.
And they will start to unwind. This is just going to increase the sell-off. But this is not a trade that we have in the portfolio. It's something we watch out for. As things develop and become a lot clearer, then we're going to start putting trades in. And anyway, with where the US 10-year rates are, you would need to have shorts in tech and high PE, right? So a lot of these ideas would work a lot better if you have a carry trade unwind. And you'll never know the exact date when this might happen. It's a risk and it's a surprise event. But if it happens, you just need to make sure you're not caught out. That's the first priority. And secondly, if you don't get caught out, can you position to make money on the back of these events? Because it's not going to last for one day. It's going to be there for multiple weeks as people are unwinding and there's just bloodbath in the markets. I mean, you saw it with Lumentum Holdings, right? It went from like 67 to 40, right?
Yeah,
And then once the whole thing was over, it recovered all the way back to 60, 63, 65, and now it's trading at like 84 or something. Um, was the sell-off linked to anything happening fundamentally within Lumentum Holdings? Not at all. Um, and then when it comes back stronger because the fundamentals have become even better,
that's right.
right? Um, I think I've got three more slides because I want to speak to you a bit more and not just, be the only one driving the discussion here. So I'll wrap up on these three slides and then we can open up for a bit of more of a discussion. Um, so, of course, since my last couple of presentations, I've been focusing quite a bit on long ideas, right? It's not to say that I'm not shorting anything, but because we're going into a fresh year, we need to have a lot of preparation being done in terms of situations that we believe will rally for the next 3 to 6 to 9, 12 months, right? So, what are the types of long trade ideas out there? The first bullet point is literally the bulk of your long trade ideas. These are purely on the basis of sound fundamentals within the business, right? So when you're going long an idea, what you're looking for is alpha, right? So if you're looking for alpha, essentially what you're also looking for is for the business to perform extremely well, and then when they report their results, the results are above what analysts had estimated. That's what's going to drive the stock market or the stock price higher, right? And then the second lever of what's going to drive the stock even higher would be management saying we're upgrading our guidance for next quarter and for the end of the year by this amount. And then all the analyst estimates would be upgraded upwards. That's going to cause, a second lever for the stock price to go up. These are literally the types of situations that you're trying to play. So fundamentally, this is what you're looking for. This is like the bread and butter types of long trade ideas. And then on the one side, you want fundamentals to be improving much more than what people have expected. And on the other side, if you're able to get these companies at relatively lower valuations than what they should be trading at when they actually execute on their plans, then that sets the tone for massive gains on the long side. So these are the factors you're always looking at. You want that company to be an industry leader, or if it's not number one in the industry, at least it's growing above what the industry is growing at. Let's say you have 10 companies within an industry. The industry on average is growing at 10%, and then you have the top three companies growing at 25, 20, and then 15%. So within these top three, I would still consider them to be good long ideas because they're all above the sector growth, right? They're all above the industry average growth levels. Generally, when you have companies that are growing quicker than others, it means that they are doing something that is better than the others, right? They understand their markets better. They may be more nimble. They deploy capital more productively, and this is what you need to be looking for, right? You're not there to look for companies that uh, are growing at or below the industry average. You could still do that under different conditions, but by and large, what you're looking for is these these companies that are amazing at growing. Um, Secondly, what we're also looking for is, let's say you have like out of these 10 companies, three are growing above the industry average growth rates, and then the rest of the seven they would be growing at the average level or below average, right? Amongst these laggards, there might be one or two companies that are now playing catch up. So they've been overlooked because in the past they haven't delivered, but now maybe they have new management, maybe they have new strategies, or maybe the same management, but they are now looking at executing differently. So these companies are shifting gears, and they'll be generating much higher future EPS growth. So this change in strategy is not yet priced into the analyst estimates. So these uh, these new strategies could take the form of new products, new go-to-market strategies, distribution channels. So maybe they were always selling in store. Now they want to also have an online presence. So that's a new distribution channel. Maybe they partner with someone like Walmart for distribution. So that changes the strategy quite significantly from what they were used to before. They might also have new expansion strategies. So maybe they're looking to acquire other smaller companies to gain market share, or they're looking to launch new stores. So maybe for the last 3 years, they have not necessarily deployed capital in terms of expanding their base within the US. And now they say, okay, we're going to earmark this amount of capital, and we want to increase the number of stores from 50 to 100 in the US. So that's of course going to drive new growth for the company. And at the point of them announcing it, it would not be priced into the stock. So if you stay close to these companies, you would understand what management is trying to do and when is the right time to start looking at them and to start positioning for them in terms of taking positions into their share, their equity, right? Whether that's through CFDs or just buying the shares or having an option trade out there. So other strategies could also involve measures to improve margins. So we've seen this with a few companies where they right size, they sell some factories, um, they relook at the way they source raw materials, and it's all in the name of trying to get better pricing to improve their own margins. So by and large, this is what we're always looking within these different companies, industries, sectors. And if you look at all the ideas that we've discussed, I think a large part of these ideas would have these factors. Um, I think, Bhavan, you would identify quite a bit with these bullet points, right? We've looked at Trimble as an example. Story there is used to be like a boring company, doing a little bit of consultancy within the agriculture space, construction space, nothing much happening for a long time, and then eventually management decides to pivot the business model and introduce software that they're selling to their client base. So the market looks at this and says, not yet convinced. And then eventually when the results start coming through, then the market realizes, okay, they're actually executing well on their new plans. And this new strategy is much higher margin than what they had in the past. And that causes the stock price to re-rate upwards, quite strongly. Um, Trimble was a massive winner, right? Of course, you didn't play it into earnings, but still, if you look at the share price, I think it's a big testament to what causes explosion of the share price, right? And that's basically what you need to be looking for in your next long trade ideas. You also have other types of long trade ideas. So this would be where companies are executing on corporate actions, which could be in the form of buybacks, dividend increases, debt reduction, mergers and acquisitions. So there you have to be a little bit more, I'd say, let's say, sophisticated to understand exactly what the proposed measures would do to the equity. Um, I would not expect a complete beginner to be able to figure out how to look into these corporate actions and understand exactly what that would mean for the equity price. But it doesn't mean it cannot be done. You just need to have the right guidance, ask the right questions, and you know understand what is the timeline that's being proposed and how is that going to impact the share price. So a few of our long trade ideas would have these as catalysts as well. Then the other category of long trade ideas that we look at tends to be turnaround stories. So Tronox Holdings was a big one for us this year. I've documented this quite well, so you can always go back and see what are the factors to look for in a turnaround story. Uh, so I did a masterclass, I think it was around March, where I explained the principles behind a turnaround story and what are the things that you can look at, that's actionable. And then I put that into perspective with Tronox Holdings just to give you more perspective and context in terms of how we execute these strategies and what are the factors that we look at to get conviction and how we also structure these types of trades or situations in the portfolio so we stack the odds in our favor. So I'd welcome you to watch this video again. I think I'll watch it again as well because I still get a lot from watching my own videos. It refreshes my mind on these situations that now look like a century old. And finally, sometimes we also play candidates that could be ripe for a short squeeze. So these are purely technical factors of the market where you have a large part of the market that's positioned wrongly into the stock, and then one or two good things about the stock could cause them to close their trades and cause the share price to go much higher. So that's another type of long trade idea that we also put in the portfolio. So at any point in time, your watch list and your portfolio need to have a good mix of these ideas. This is something I wanted to speak to you about because I think whenever I'm in the Discord server, I get the feeling that people are focused on today. What is the stock market doing today? And, scratching their heads and trying to figure out, oh, why is this moving against me, etc. But as you go into the year end, that's not where you need to be focused. I think you need to be focused on 2025 and start to do your research well in depth and put yourself in a position where you're very well prepared going into 2025. So what tends to happen around year end is that a lot of fund managers would look at their non-performing stocks, industries, and by that time they've had the trade on for maybe 12 months and they're tired of it and they're like, this company has promised so much and nothing happened. This company will never do well. It's like a lot of emotions around these companies and situations. And they want to go into 2025 with a clean slate. So they don't want to see that on their portfolio. And that leads them to sell a lot of these situations that have been performing poorly. So from our perspective, we see this as indiscriminate selling. But meanwhile, what could be happening is maybe they were just too early with these companies, and now the fundamentals are actually improving and therefore increasing the prospects for EPS acceleration. So this is the type of situation that is great for us because it allows us to find companies that are set up for a potential inflection point. And also because there's been this indiscriminate selling into the year end, the valuations are relatively lower. So for us, we would interpret this as, maybe the selling in the stock is done. When we come into January, maybe, all the sellers are done and now you don't necessarily have meaningful holdings within funds. And, if you have high holdings within funds and the company hasn't been performing, that sets the stage for more selling. But if that's already been done around year end, we know that there's reduced downside potential. That's great for us if we want to go long. And also, if the fundamentals are improving, that set the stage for significant re-rating from here. So we have a situation with limited downside potential and high upside potential. That's the reason why we need to be dumpster diving and looking for these situations. I think I mentioned one such situation for me in probably 2021. It was Scorpio Tankers. So the company went from 19 to 55 in the space of 6 months, or maybe 8 months, I don't remember. Um, and imagine playing this through options, right? And this is not the only company, right? You have many such companies. You can go do your own research. You have many such companies that go up like 50, 100% in the space of a couple of months. And imagine if you're able to catch these companies ahead of time, position for them, play them a couple of times over the year. That makes for phenomenal upside. So, final slide, the roadmap to 2025. We need to be fully prepared with a rich watch list of long trade ideas. So we need to be realistic as well, right? Just because a stock is trading at a low price or it's down, 90%, doesn't mean it has to go up, right? If anything, there's a good reason normally why it's down 90%. So we have to be realistic with the fundamentals, and we have to find as many factors that confirm that we can have an inflection over the next 3 to 6 months. Often this will require in-depth sector industry analysis. So you'll have to, look at it from a fresh pair of eyes, independently assess it, and then compare versus what the Wall Street analysts are saying in terms of estimates. And from there onwards, based on your own fundamental work, you decide whether there's a significant potential for upside surprises for that company. I think we'll also start seeing capital rotating to the value low PE space, and with that, turnaround situations will also tend to do better, right? Turnaround situations do, they rely on only one thing, the fundamentals of the company improving. They rely less on valuations. As an example, if a company is eventually turning from loss making to profit making, it's not going to go up because the PE is 10. It's going to go up because when you look at the next few years of EPS versus today's share price, that sets the stage for significant gains. In other words, what I'm trying to say is, don't just go into a screener and say, okay, I'm going to buy everything that's trading with a PE below 10. That's not going to work. That's just too random. You need a combination of, good things happening fundamentally, and it has to be realistic as well. And then if you are able to get it at a relatively low valuations, that's like even better for you. Also, you have to be fully prepared with short ideas where fundamentals are weakening and valuations are stretched. So we have many such situations in the tech space, also in the high PE space. A lot of situations where maybe investors are expecting infinite growth from the company, which will not happen, especially as GDP slows down. So with GDP slowing down, the US 10-year rate staying elevated, that's creating the perfect example or perfect environment for many of these high PE situations to correct meaningfully. And if you're short one or two of these ideas, that's easily 400, 500% if you're playing it through options and if you do it correctly. As always, stay flexible, maintain a diversified long-short portfolio. I think 2025 will be just another year full of twists and turns and, head-scratching moments, celebratory moments. But at the end of the day, we still need to make money overall. And that's literally the only objective here. With that, I'll end and open up for any questions that you might have. Any questions?
Oshan, not a question about the presentation per se. It's more like, so I was looking a bit about the thing you said about Trump bringing manufacturing back to the US.
Mm-hmm.
Was looking around automation.
Mm-hmm.
We came across a company, Symbiotic something, SYM, a symbol.
Yeah.
It looks quite interesting, but I think the earning is on Monday, and I won't have enough time
Mm-hmm.
to research it properly. But just wanted to ask your perspective, like in terms, if I had to prepare a thesis for that company, like what would you be reading and preparing on?
Um, so thesis for 2025 or
Yes.
for this quarter's earnings?
This quarter, I don't think it will be realistic because it's tomorrow.
Okay.
Yeah, so for
Yeah.
this.
So um, it's not very different to what we normally do. You probably start off with the company presentation, try to understand what the company does, um, understand where it's been at. So if you look at the stock price, try to understand why it's been selling off, from the start of 2024 all the way to, let's say, September. It's only now kind of rallied a bit. So you
Yes.
have to understand what's been driving that. Also understand what the future looks like for the company. What is management saying about projects that they're going to be doing? Um, how does management expect to grow revenue? What are the margin improving measures that management is forecasting? What are the challenges that the company is facing? Because normally, we can tend to look at upside too much and forget the challenges, which are very realistic, right? So this company would rely quite significantly on industrial activity. And even if we have the reshoring happening, it's not like it's happening at a phenomenal pace, right? It's a multi-year trend. And if on the whole industrial activity is reducing, as we can see with the ISM, it's not projected to improve if we look at the ISM new orders. So it doesn't give us a good backdrop in terms of the general industry state itself, right?
Mhm.
So we have to understand why is it that we are going long this company. There must be a very good reason because we're kind of deviating a little bit from what we would normally do. So there might be like a stock specific factor that still makes this like a clear winner, even if the ISM PMI is not yet recovering. Or you might wait a little bit and say, look, I think the ISM was basically stalling because people were caught up in uncertainty with elections and everything else. Now the backdrop looks like this. We have Trump, who is pro-manufacturing, pro-local manufacturing. We have a Fed that will probably cut more into 2025, so that's a very good backdrop. Maybe you wait for a couple more ISM reports to get confirmation that we are indeed seeing a turn in the ISM new orders. You don't need it to go above 50. You could, if ISM new orders just increase maybe for 2 months in a row, even if it's still contractionary, that in itself could give you enough fuel to go along the company. But generally, for these types of companies, you would look at idiosyncratic risks. So basically, company-specific fundamentals, because it's possible that this company is still growing in the middle of the ISM not necessarily indicating growth. Just because it has a niche market where there's still growth. So as an example, um, let's say, for instance, if it's involving anything to do with semiconductors, then that's not really been impacted by what the ISM reports are saying, right? So you have within any industry, you have these pockets that just do their own thing, irrespective of whatever's happening across the industry. And if you find these, uh, normally you'd be able to find very good long trade ideas. For this company specifically, what you could do is just get ready for Monday's earnings.
Yeah.
Uh, you don't need a detailed thesis, right? You just need a good understanding of what does the company do, why has it been trading the way it is, what are the challenges, what has management said in the last quarter's call, and then what are expectations like going into this earnings. Then on Monday, you just refresh your understanding of the company, and that in itself would give you like a very good understanding of what the company is doing, how investors react to different types of news within that company, um, whether it's something that's coming out of a hole or whether it's still going to be in a hole for many quarters.
Yeah.
Um, I think one thing that I kind of find with beginners, not just beginners, also people who have been trading for a long time, is there is this illness that I call chart gazing. So they spend the majority of their time flicking through charts and looking at companies. The prices are moving live, and they get something out of that, but it's literally wasting time, right? Uh, and that prevents them from actually going a couple of levels deeper, pulling out the investor reports, you know, just I think what's more productive sometimes is to close these charts and then just look at the fundamentals, right?
Yeah.
Assess it as a assess it as a fresh new idea. Then when all your work is done, you look at the chart. That's the literal process. Um, what I see people do is they need the they need the chart to be moving in the direction they think that the company will move before they are able to go and you know commit time and effort to an idea. And I can understand this, right? You've got restricted time, you want an idea as quickly as possible, and somehow you think that the price action gives you validation that your idea is good. But if you think carefully, right, a lot of the big winners this year, we put them when the market was not agreeing with us, right? Um, Many such companies, like as an example, Bhavan bought Light, so Lumentum Holdings, when it was around mid 40s, when it just corrected by like, I don't know, 20-30%.
Mm-hmm.
And he was able to do that because he knew that the fundamentals were still sound and that the sell-off had nothing to do with the fundamentals. And on that basis, he's been able to make massive gains, right? So that's what we have to understand, right? We don't need the market to agree with us before we pull the trigger and start our research process. I think you just need to be a true student of markets, businesses, and then you express it through the stock market, right? You're always trying to find out what's going to happen with this company, and that's the seeker's journey. You're not doing this because you get dopamine from hitting the buy or sell button. You are genuinely interested in finding situations where managements are implementing something new, and you want to actually see it through and understand, okay, how is that strategy going to change the business? And you stay close with that company for a couple of months. And in between, if you've been able to formalize a thesis and play through the stock market, even better. But I think that's what I tend to see a lot of times. People uh, are very reluctant to go into the investor relations segment and just get the data and start analyzing it. It's easier to go to a chart and look at it moving up and down. People get a lot of pleasure from that as opposed to looking at a PDF that's not dancing around. And that is literally what's standing in between your success, your phenomenal success as a trader, and basically being on the other side where you have a portfolio with not so many ideas, where the ideas are stale, and you're suddenly moving from a trader to a long-term investor just because your idea generation process is broken and you just cannot get yourself to find new ideas. It's something that everyone struggles with, by and large, including me. So I remember when I first started out, or maybe if I can give you a perspective that's fresher, right? So this year, 2024, I've been putting a lot more constraints on myself in terms of how I spend my time, which means that I cannot spend 12 hours doing idea generation. There are other things that need my attention, right? Let's say if I'm running a business, I have calls that are unrelated to trading. I want to learn something new. All of this needs my attention, time, and effort. And I'm kind of putting constraints on myself in terms of, okay, you have to do all these other things, but it doesn't mean that your trade idea generation would suffer. So by putting constraints to a situation, you also are able to become a lot more efficient, right? Because within you, you know the road from start to finish. And it's a bit like when we go hiking, right? We know the straight line to the finish line, but we will stray. We'll find like a plant, and then we'll go play with it. We'll sit down in the shade. We'll go to see a river, waterfall. And when you put constraints on yourself, you tend to go more in the straight line and go from start to finish. So you train yourself to have the process, done in a very efficient manner. And then you start to realize, actually, I could do trading and other things as well. They fit in very well. But with many people, they just sit there, they chart gazing, barely even opening, the underlying information from the company. I cannot tell you how many times I've got people who they're asking me, so where do you get the company information? Where do you get all these graphs? And they've been trading financial markets for years. And I'm like, how could you be trading stocks and not know that the company puts out information about its business? This is very contradictory in my head, but you have people who are out there who are like this, who've never seen any of these filings, don't even know where to find them. And it's basically my job to tell them that, this is an essential part of what constitutes the share price. And you have to do at least a minimum level of fundamental work before you have a view on the company, industry, and so on. So yeah, long-winded way to answer your question, but I think this is something that I keep emphasizing. The simpler your process is, the more successful you will be. The more you're looking, so if you look at your time and you were to audit it, the more you're looking at charts, the worse you'll be, the worse ideas you'll be getting. The more you're spending time within company presentations, management call transcripts, coifing, looking at numbers and understanding what's driving the business, the more your brain is kind of tuned to find new trade ideas. The more situations you know about in the market, the richer your watch list and the fresher your portfolio. And of course, the returns you're going to make are also going to be much better, more superior. And it will also feel like less work, to be honest, because you're not straying, right? You're just going from start to finish in the most efficient manner. And you just sit there, put the position on, whether it works or not, then you replace it and you keep doing that. And suddenly you realize you've unlocked many other levels. Bhavan, any questions? Or Hans, any other questions from your side?
Oh, good. Thanks.
Yes, Roshan. I'm also um, I want to get your thoughts on like 2025 watch list. But you mentioned, I think you mentioned that like in the chat too.
Mm-hmm.
So how are you thinking about like obviously the market it will be positioning for like um, this upwards in like onshoring and all these trends, but these trends doesn't look like something that can happen overnight or over a few weeks, right? It's like a long term
Yeah.
trend. And how would you like when you say put it on your watch list, what what does that essentially means? Like you will somehow get a confirmation. Okay, this is at one time in the future that okay, it's time to trade. And what kind of confirmations you will be looking for those?
So what I've got are high-level themes, right?
Yeah.
So you will always look for confirmation signals within uh, the company or companies that you're looking at, right? Being well aware of this is the prevailing trend, and you're right. Even if you say I want to play the manufacturing reshoring theme, I want to have one or two ideas in my portfolio on this. Um, this theme has started many years ago, right? So from January to June, maybe that theme is not necessarily prominent. The market is not necessarily focused on that. So if you have the trade on, it's possible that it will not work. But the longer term trend is that there's going to be more and more of this happening. And then you have to express this theme within a few companies that you've researched well and that are positioned to benefit from this trend. So essentially what you'll do is, especially going into 2025, like Hans has just mentioned, uh, Symbiotic, that's the company, right? Yeah, no, Symbiotic. So you'll find companies like these, and then you will research them, put them on your watch list if you like them, and then you will start waiting for signals that some of the things that you were thinking of, why would you think that uh, robotic automation would be something that would attract more revenue? It's because new factories are being set up in the US and they don't want to set it up in the traditional manner. So what's causing the new factories to be set up in the US? This whole manufacturing reshoring theme. So the theme is important, but it's also something that's a lot more distant from the company, right? This is something that we have to understand. The theme is there. It's kind of driving things from a very long distance. And then the real expression of the theme will happen through that particular company. And then you would still be looking at, let's say, 3, 4, 5, 10 companies within this space. Maybe one is robotic automation. Another one is involved in, let's say, roofing for industrial facilities. Another one is involved in steel manufacturing. Another one is involved in maybe distribution of construction materials to commercial construction contractors or whatever, right? So these are all the same theme, but expressed through different companies. And then once you've researched them, you will know what are the next catalysts that you're waiting to unfold for these companies. And then you'll keep a close eye on them. You might even start playing them in your portfolio. Uh, but what I'm trying to say is, at the start of, let's say, at this point in time, right? You have, let's say, 2,000 stocks trading in the US. You need a few stocks on your watch list. If you have no direction, you don't even know where to start, right? You cannot go and research 2,000 stocks. So by picking a theme, you're narrowing it down to maybe 5, 8 companies, and then you're narrowing down your research within those companies where you believe you would have actionable catalysts, right? And by doing this process, you're much closer to these companies than you would be at this point in time when you haven't even researched them, right?
Yep.
So that is the essential part of it, because once you know the story, uh, it will take you half an hour to just refresh everything and decide if it's a trade or not. But if you don't even know what the company does or what other companies within that industry, uh, it will still require a couple of days, weeks of work to just get a good understanding of how the industry is laid out, right?
Yep.
So um, again, if you approach the process with the intent of saying to yours, of finding, definite trades, that's completely wrong, because
Yes.
uh, you have to leave room for some exploration, bouncing around, finding ideas that are probably not sound. It's all part and parcel of understanding the industry landscape. And then once you've outlined what the industry looks like, what are the themes within that industry, you would know very well, if this happens, I have to express my idea with this company. Let me give you an example. Let's say uh, the price of steel is, oh, let's say Trump puts tariff on imported steel, right?
Yep.
And you've researched companies from that particular theme, and you have one company that produces steel locally in the US. You know exactly what to do next, right?
Yes. Yes.
But if you had not done this, now you're scrambling and trying to understand, what does that mean? Who are going to be beneficiaries of that? Oh, someone who produces steel locally. Does anyone produce steel locally in the US, right? You're too far out in the whole exploration process, and
Yes.
you're
Yes.
likely to be late to the trade or feel like there's too much work to get ready for you to be able to execute a trade. I think we saw a similar situation with the oil and gas trade, right?
Hmm.
Um, very purposefully, I left it out to everyone to do their own research, and no one came with any idea, right? I
Yep.
even gave people a proper layout of the industry, the different participants, and everyone was just clueless. It's almost like I had to give you, okay, long this sticker, short this sticker, and then you feel enlightened, and that's completely wrong, right? Because
Yep.
then you're putting ideas in your portfolio that don't belong to you. So when they don't work, you don't even know if they're not working. Um, if they're up 5%, you'll call me and say, hey, this was great. If they're down 5%, you call me and ask me, hey, why is it down 5%? As if I'm the one who controls the share price. And this is completely wrong. Um, that's the reason why you don't see me. Uh,
Reluctant to
you
put
know,
like anything with the
I don't
stickers.
share I don't share ideas that much, right? I mean, sometimes I feel like, okay, I have to give you guys enough so you can start chewing on it, and it doesn't feel like it's the whole world against you. But this is not something I'm gonna do all the time, right? Because the whole philosophy is that you need to do it on your own to learn the skill. And if this was just like me giving you stock tips, then that's not the intention, you know. The,
100%.
the intention is to impart the skill, to help you practice it, to help you go out in the market, do your own thing, come back and say, Roshan, I looked at this company. This is what I'm thinking. Have I missed something? How would you be thinking about this company? What are the questions you'd be asking? Uh, I'm thinking of going long this company using this structure. Does this make sense? Um, have I missed something I should be thinking of? That's what I'm looking to do, right?
Yeah.
I'm not here to say, you should go long this company. This company will definitely go from 60 to 65. And do you
Yeah.
see this? You see this baby?
Yeah. She.
It's looking for food. Okay. So,
Okay.
the whole goal is not to say there's a list of tickers I want you to go long, buy calls at this price, and just make money without even understanding why you're making money, right? I could do that. I could open my watch list to everyone and then get people ask me a million questions. How did you find this company? How did you know this company would move? Uh, we could do that where I'm kind of showing you, okay, look how much I'm winning, how much I'm losing, but
Hmm.
you're learning nothing in the whole process, right?
Roshan, is it right to say when you're giving us these themes, like long idea themes, short idea
Hmm.
themes, um, like behind the screen, what's happening, like personally for you, is also like within these teams, you are trying to identify
Hmm.
few companies that might be a trade idea or a watch list idea,
Yeah.
and then you have, and that is your watch list, right? Like you have prepared your watch list for all of these different ideas that you're giving us,
Hmm.
and that's how that's what you mean when you say prepare for 2025. Is that right?
Yeah. So when I'm sharing like the long themes, short themes, this is basically me sharing what's happening in my head.
Yeah.
So I'm standing there in September, and this is how I'm seeing the backdrop. I'm thinking, okay, if employment has peaked and it would come down from there, these are the companies I want to start looking at shorts because there's no way they will be spared, right?
Hmm.
So at that point, I might not even have started the research process. It might just be like a thought that I'm getting, because I'm always asking myself, what are the themes, right? If
Yeah.
oil is gonna come down, who's gonna go up? Who's gonna lose from that? So these are all high level thematic ideas that I'm thinking about. Like if there's capital rotation from high PE to low PE, let me put that there. Maybe someone will get a bit of direction in terms of how they're looking at their trade idea generation process. Because if I call you and I say, okay, go outside of your house and walk, right? You'd be like, okay, I walk in which direction for how long? Where do I stop, right?
Hmm.
If I give you a bit more guidance and I say, go outside your house, walk towards town, and don't stop for the next half an hour. Now you know conclusively what to do, right? But it's this conundrum where you have 2,000 stocks trading and you have no sense of direction, and you haven't done it in the past. You don't know how to generate a trade idea, and you feel lost out. You feel like, okay, the market knows much more than I do. I don't even understand what moves stock prices. Why do I even care, right? Uh, and a large part of the workshops are designed to kind of
Give us a
demystify this
filtering
approach.
process. Yeah.
Yeah, yeah, yeah. I mean, I think if you've paid attention, you would understand by now how financial markets work to a large extent, right?
Yeah, definitely. I think
Uh,
like the macro backdrop is actually like something I'm keep on learning from what you are given.
yeah, and 6 months from now, the way I'll be looking at price action analysis might change because other things are driving the market. If we go in a bear market in 6 months, right? Everything is just selling off. I'm of course going to be looking at price action analysis differently. You'll of course see different charts, right?
Okay.
If we go in a high volatility environment, of course you'll see more charts around volatility and the factors that are driving volatility. So it's not a process that's kind of okay, you do 5 slides on this and then this works for all market conditions. That's why you have to understand the principles, what moves financial markets, and then start from there and build up from, from principles to actually what's happening in the market. So, I mean, coming into this presentation, I was kind of in two minds. I wanted to give you a few ideas for 2025, but then I kind of said, no, let's give the principles and then let them chew on it and then see what they come back with. Um, I can almost bet that we'll get nothing out of all these all these kind of themes that are put out there, which eventually will mean that I have to start sharing ideas, and people will just read it on the Discord and feel like they now understand the situation and put it in their portfolio and make money, which is totally wrong because they'll never learn how to do it themselves. So I think, Bhavan, you said something quite insightful the other day. What would happen if Roshan just decides to stop sharing anything on the Discord server?
Yeah, that is the risk I'm trying to hedge against.
Yeah, I mean, think about it from that perspective. What would happen if I just said, you know what? Why do I waste my time on a Sunday for 2 hours and spend my time putting things on YouTube and all of that nonsense? Let me just go back to my own world, find more ideas, make more money, and I'm not losing anything. So that's a big risk for all the guys in the Discord server. So that's the reason why people have to pay attention and move with the flow in the Discord server. If I put something there and then 3 months later you're reading it and asking me a question about it, I'm like, I don't want to waste my time on this. And this is very important because when the world flips, then you also need to know how to make money in that world. So if you're always looking for ideas from me or someone else, you're never really learning the skill, right? I think you would be quite encouraged to see that couple of your ideas that were sourced without me giving you any hints have worked out so well, right? So it shows you that you're looking at the right things. And that if you keep walking in that direction, the world is just opening up with infinite opportunity, you know?
Yep.
I think the last couple of weeks of price action has also showed you the risk involved with having, these trades on. So when the market environment changes, a lot of things can change, and you have to be able to pivot your portfolio accordingly. Otherwise, you get caught up, and your ideas that were working really well could suddenly stop working. And if you're playing it via options, you have to understand that this is a big risk, and you take profits accordingly. You make sure that you've reduced your risk as much as possible, because every day you could wake up and things look very differently. Nothing is for guarantee, right?
100%.
Okay. Any further questions?
Not from me now.
Yeah, not for me.
I think I have one last thing I probably would like to say to both of you. So if you're looking to 2025, look at the agriculture space. So that includes maybe have a pen and paper close by and write these down. So agriculture, look at fertilizers. I think this is nothing new. We've spoken about this. Look at so basically go to Finviz, go to the screener, and then look at all the stocks maybe above a billion market cap, maybe 1 to 10 billion market cap, that have performed very poorly on a yearly basis. So that will probably give you, I don't know, hundreds of ideas. And then within that list, start looking at the industries that you believe have more prospects in the future. So that will give you a lot of direction as to where you should be focusing your research. So I'll give you one example. We've been hearing about electric vehicles, not necessarily selling as much as in the past, and prices coming down and so on. All these factors are never permanent. Maybe in 2025 that stops and it reverses. So at that point in time, there are many companies involved in that value chain, right? So do some work on a couple of companies that could re-rate upwards quite violently. Many companies involved in producing the powertrains, producing batteries, producing software, producing the semiconductors that are needed for EVs. I'll give you one ticker name, ALGM. So do some work on this, and this would literally be a play on EVs coming back into play. So of course, with Trump lashing out against clean energy and so on, the EV space looks grimmer, but it will not go to zero, right? That's what we have to understand. I have some other situations that I was at. I think I would start looking at high PE for more shorts. I think there are longs and shorts within this high PE space. There are companies like, have I spoken about Roblox in Discord? Maybe not so much, right?
Not like an analysis, but you have mentioned that an example of.
Yeah. So Roblox is a good example where the fundamentals were improving, but the price action was just dismal. And then they had yet another quarter of improving fundamentals. So more users, more revenue per user, these KPI metrics were just inflecting. And the stock just rallied, I think, 20% or something on earnings, and it just kept going from there. So, even if it's within the tech space, you have these companies that, people get tired of them because they haven't been executing to their liking, and then they just sell these off. But fundamentals are different from share price. So if you're able to find these companies, and they are very easy to find, right? You look at the company presentation, the earnings presentation, and so on. They give you the KPIs. You just have to understand whether it's a business that's improving and whether that's priced in. And on that basis, so I'll give you an example. Let's say you have a business that relies that, let's say it's a software where they pay per user, and it's mainly sold to corporates. Now, if you see that the job market is weakening and fewer people are getting employed, it also means that fewer people will be using that software, right? So is it difficult to see that will just be declining from here onwards until the job market is back in strength? Of course not. So if you look at these ideas, they're very likely to be very good short ideas. And it's just a matter of you going into those in-depth PDFs and just forming a view on the company. And then on that basis, look at the stock price, look at the estimates, and then understand whether it's been priced in or not. So there'll be many, many, many companies like this. A lot of beaten down companies that can inflect quite significantly. Maybe lastly, With this whole sell-off in the healthcare sector, I think there are opportunities. I was reading in the ISM services commentary. They were saying that there were there was one IV factory, so intravenous factory, that was damaged during the storms. So that would make it difficult for supplies of things like syringes, surgical needles, and all of these medical equipment. Uh, when do we start seeing companies that supply these materials? When do we start seeing that in their financial results? It won't be long, because if there is a shortage of these equipment, the pricing would go up, and a lot of these companies, their share price is not taking that into account, and these are definitely areas where you have inflection points. And it has probably nothing to do with Trump or his policies. So they might have sold off because the entire health space was just selling off. And then you find these companies with improving fundamentals, and they easily give you 20-30% upside. You play them. Boring companies which make you a lot of money. And also, if we go in a defensive mode in terms of setup from market participants, healthcare will also start rallying from that basis. So you get the combination of alpha and beta for your idea. So you see, that's how I'm looking at markets. I'm not necessarily looking at this as uh, look at this crap company that's rallying just because of inflows, that's frustrating me, or 1 out of 10 of my trades hasn't worked and I really thought it would work, right? I'm not looking at this at the moment. I'm looking ahead and just trying to figure out where there's a big gap between uh, estimates and reality, or where reality will eventually end up. Okay, I think I'll end up here. If you haven't got any further questions, thanks very much for your time.
Thank you for your time too, Roshan. It was
Thanks.
really
Okay, cool. So yeah, last question from my side. What are your objectives for 2025?
I think definitely work on the watch list.
Mm-hmm.
Yeah.
So,
I,
how many positions would you ideally like to have in your portfolio that's actively trading?
For me, I'm thinking about 10.
Okay, 10 live positions, right? So five, let's say 5 long, 5 short.
Yes.
Bhavan, yourself?
yeah, I would say 6 to 10 too. 10 because that is where you try
No.
to get us, and 6 because I know the reality.
Yeah, I
Um,
mean,
yeah,
see,
6 to 10.
ideally it should be 10 to 12, right? But
Yeah,
8 to 12 also works, because
8 to
you'll
12.
also be taking ideas off, and maybe you're putting an idea right away, right? So there's a bit of flux there. But what it means in essence is you need to have a watch list that's relatively healthy, right? So healthy means you have enough ideas, enough diversification within your watch list, and the watch list is also fresh, actionable, and that requires a bit of work, right? Of course, you have to be spending quite a bit of time looking at these situations. But think about it from this perspective: you have 52 weeks in 2025, right? If you do one idea per week, by the end of 50 weeks, let's say 50, we're gonna give you 2 weeks off, right? So by the end of 50 weeks, you have 50 ideas that you've looked at, 50 situations across different uh, sectors and industry. Do you realize how powerful that makes you? That's just one idea per week.
Yeah.
Now imagine if you do two, three, or two. I think two is decent. You do two ideas, well researched, let's say you spend 6 hours per idea in a week. I think that's a bit too much, but let's say with you sifting around for your info and all, it takes you 6 hours. So I'm basically asking you to work, let's say, 10 hours on just trading and finding your trade ideas, right?
Yeah.
So if you can find 10 hours within every week, and I think that's highly doable, right? That's basically 2 extra hours per week, assuming there's 5 days in your week. That still gives you a bit of time to rest and take care of other things in your life. Uh, that's not a lot of time if you think about it, right? If you cut off things that basically add no value to your life, and if you're able to do that, by the end of the year, you have 100 situations that you know of. You've written something about them, and you can play them now, later, or even in 2026. So that makes you really powerful.
Yeah.
And you know, the gap is not that much. And whenever you struggle with something, just give me a shout. I'm there to help. Um, and of course, the more you share your ideas, the more I will be inclined to share mine too, right?
Yeah.
I'm not going to share my ideas with a bunch of people, that have fleeting interests, right? Uh, I will share my ideas with people who are involved and want to learn more. Um, because that's basically what's driving me, right? I want to share with people who are like-minded and looking to figure this out on their own. Um, that's all you have to do. Just focus, cut out things that take away from your time, keep focusing, and then you'll see after a month or two, your process will evolve. You'll become a lot more efficient. You'll even start challenging me on my own ideas, which is the best thing to do, because then it means whatever I'm discussing with you is not kind of aligning with your own way of looking at things. So I might be wrong, or you might be wrong, but either way, there's space for positive contribution, right? Whereas if I say go long this ticker, go short this ticker, and you say yes, sir, then you're not learning anything, right? So yeah, this is where I'd like us to be in 2025.